Ladies and gentlemen, good day and welcome to the India Shelter Limited Q2 FY26 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you.
Thank you. Good evening, everyone. Welcome to India Shelter Q2 FY26 earnings call. On behalf of ICICI Securities, I would like to thank India Shelter management team for giving us the opportunity to host this call. Today, we have with us the top management team of India Shelter, represented by Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, CFO, and Mr. Rahul Rajagopalan, Head Investor Relations. I will now hand over the call to Mr. Rupinder for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Renishji. Good evening, everyone. On behalf of the company, I extend a warm welcome to all of you. Thank you so much for joining us on the call today. Let me start with some broad macro updates. Headline inflation is expected to stay towards the lower end of RBI's target band in 2025-26 after experiencing significant moderation during H1 financial year 26, mostly as a result of sharp correction in food prices. Despite flooding brought excessive rainfall in number of states, the prospects for agriculture industry remain positive. Adequate reservoir levels, helpful policy actions, and above normal monsoons in the majority of regions all contribute to this promising outlook. With significant increase in sales of fast-moving consumer items in rural regions and positive sales of tractors and motorcycles, rural demand is expected to stay solid. GST 2.0 reforms are expected to further boost private consumption and domestic demand. And high festive sales volume and consumer emotions already indicate a revival in household discretionary spending in both rural and urban areas, which should help credit expansion in coming quarters. The growth outlook is still supported going forward by reduced inflation, increased capacity utilization, favorable financial conditions. In the short run, the government's persistent emphasis on capital spending, GST changes, and bettering lending conditions should increase aggregate demand and support the sector's strong momentum with robust loan demand. On that note, let me move towards the quarterly update of India Shelters. We are pleased to announce that the company delivered another quarter of performance. We delivered an AUM growth of 31% year-on-year, reaching an AUM of rupees 9,252 crores. In Q2 FY26, we disbursed 931 crores, registering a growth of 12%. In Q2 FY26, we added 9 new branches as a part of branch expansion strategy. Geographic presence stood at 290 branches as of 30th September 2025. Gross stage 3 and net stage 3 came at 1.2% and 0.9% as of 30th September 25, as against 1.2% and 9% same year last year, 30th September 2024. On profitability metrics, PAT for the quarter came in at rupees 122 crores, registering a growth of 35% year-on-year and 2% quarter-on-quarter. Return on equity stood at 17%. Our net worth now stands at rupees 2,914 crores. We continue to see demand and growth potential in the affordable housing market in Tier 2 and Tier 3 cities, supported by government policies. Our guidance remains same. That is branch addition of around 40-45 year-on-year, of which we already opened 33 in this financial year, that is H1. Maintain spread of more than 6% in medium term. Credit costs around 40 to 50 bips and loan growth of 30-35%. Now I would like to hand over the call to Ashish Gupta, our CFO, to take you through the financial metrics. Over to Ashish ji.
Thanks, Rupinder ji. Good evening, friends. Let me take you through the key financial numbers. We have ended the quarter September 25 with AUM of 9,252 crore. Year-on-year growth in AUM is 31%. Quarter-on-quarter growth is 6%. Total income for the quarter is total income for the quarter is up by 30% year-on-year, largely driven by 31% growth in AUM. Our portfolio yield is at 14.9%, which is stable year-on-year basis. Our disbursement yield is also running at same level. On funding side, we have diversified borrowing with more than 30 counterparties. Average borrowing tenor is at about 8 years. Our bucket cost of fund is down by 10 basis points in Q2 to 8.5%. Total reduction in cost of fund in last 9 months is 30 basis points. Our marginal cost of fund for Q2 is at 8.1%. Thus, we expect to see another 20 basis point reduction in our bucket cost of fund by year end. We have received sanction of 550 crore from National Housing Bank, which we expect to draw in next 2 quarters. Further, we have received a sanction of 500 crore from SIDBI for the first time. This will help us to further diversify our sources of fund. Our lending margin are consistent above 6% in line with our guidance for medium term. Net interest income is up by 33% year-on-year, 5% quarter-on-quarter on the back of growth in our AUM and improvement in spread. Coming to OPEX, our year-on-year growth in OPEX is lower than growth in AUM, resulting in better cost ratios. OPEX to AUM for the quarter is at 4.1%, down by 30 basis points year-on-year. Cost to income for the quarter is at 35%, down by 170 basis points year-on-year. On asset quality side, stage 3 is stable at 1.2%. Our credit cost for the quarter is stable at 0.5%, in line with our guidance for medium term. Net stage 3 asset is stable at 0.9%. PCR for stage 3 asset is stable at 25%. Our total ECL is 73 crore against the regulatory threshold of 43 crore. Thus, we have adequate buffers are in place. PAT for the quarter is at 122 crore, year-on-year up by 35%. ROA for the quarter is 5.8%, up by 20 basis points year-on-year. ROE for the quarter is 17% on annualized basis with a leverage of 2.9 times. On liquidity side, we are comfortably placed with a liquidity of 580 crore and undrawn sanction of about 1500 crore. Our ALM is positive across all the buckets. With this, I conclude and now we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Raghav from Ambit Capital. Please go ahead.
Sir, hi, good evening, and thank you for giving me the opportunity. I just have 2 questions. One is, what is your bounce rate for the quarter, and if you can give me a split by housing and non-housing book? That's my first question.
So bounce rate is into a tune of 20-22%, which happens. That is on quarter-on-quarter. Sometimes if there is a weekend, Sunday or something, it goes spikes by 1 or 2%. Otherwise, range between 20-21%. That is something we keep maintaining around, basically.
Okay, and what was the split between housing and non-housing in terms of bounce rate?
So there is no difference between the bounce rate between the HL and LAP. So broadly, we are catering to self-employed segment in both the loan product category. So there is no much difference between the two.
Understood. Second question is, a couple of affordable housing finance companies which have reported yet have shown some slippages come through. What are your thoughts on the industry collections and asset quality, given that even your stage 2 ratios have gone up? Just some of your thoughts will be very helpful.
So I think last 1.5 years is discussion which is running around this piece particularly, and there's an obvious reason because of overall industry if you see not only affordable housing, but when we talk about rest of the products, whether it's MFI sector, unsecured, so there is a heat around that piece. And if there is a heat around piece, you'll always find that one product in other way, some other way, to impact the overall ecosystem basically. So there's a slight stress, but having said so, affordable housing companies do have a one strong support in terms of getting collection fast, quicker and better in that piece. And this is a reason that even if customers slippage and move to further stage which is 90 DPD and above GNPA level, the opportunity with the affordable housing company, they have always there to bring it back. So little bit up and down that keep coming. It's a long-term business, so every quarter can't remain the way it is earlier one. But yes, I think most of them are in the range bound basically.
Understood. Just for second half, what kind of disbursements are you budgeting? Your second quarter disbursement growth is only 12%. It was trending at 25-30% before this. So how are you thinking about disbursements in the second half? And then will you still stick to a 30% plus growth guidance on AUM for the year?
Yes, I mentioned during my early commentary that we'll be going to maintain this growth rate of 30-35%. This quarter definitely like rains and all, and because of GST coming late and people try to hold back anything. There are so many answers can be given around. But as I said, a month here and there won't impact here as the prospect of business and the momentum that has been built, that's going to remain there basically. So 30-35% of AUM growth, you can easily consider that happening in coming quarters also.
So that's all from my side. Thank you.
Thank you.
Thank you, Raghav.
We'll take our next question from the line of Darshan Deora from Invest Group. Please go ahead.
Yeah. Firstly, congratulations on a great set of results. Actually, the question I also had was on disbursements, but you already answered that. So hopefully the disbursements will pick up in the second half.
So this normally a trend which has been seen in history also, in the past also, for not only myself but most of the companies around. H2 is always considered to be, optimistic when compared to the H1. H1 has many factors, seasonality factors, picking up and things around that, these streamlining those things. So I think there is no reason that we should have a connotation around that this moment is not going to come up around. So effectively, we are mid of quarter, almost there, we can see that this traction is coming back in terms of taking to the, as the numbers keep building around. But I think it will be more like a forward-looking statement. But always H2 you'll find better than H1 in that terms.
Appreciate that. Thank you. And again, great set of results and congratulations to the entire team.
Thank you. Thank you so much. Thank you, Darshanji.
Thank you. We'll take our next question from the line of Sonal from AMSEC. Please go ahead.
Hi, thanks for the opportunity. There has been this question earlier, but just wanted to check how was the collection trend in October? And also, disbursements were slightly slow, not just for you, but for the entire industry. So how is the demand per se? Is there any challenge in demand? You just answered that partially saying that PVT is better. But anything that we are seeing on the demand side, and also, if you could talk a bit about the rejection rates, how they were in 2Q this year and how was it, in the previous year?
So if you talk about demand which comes in form of new customers coming for logins and all, I don't think any challenges coming around that piece. But as last 1.5 years, everyone has tried to stringent their norms. Definitely that has reduced certain amount in terms of suspension rate for me as well as most of the people which we keep also hearing along with you guys basically. Going forward, as we see that, a trend looks that is going to some more couple of months, and I think should going to come back because August was not a great month to have basically, if you ask me. But as we see September coming up, decently well, that was the quarter. So this is the beginning of next quarter. So I think we'll be able to come back, as for the trend what we have seen the history year or 2 years or 3 years back basically.
Okay, and congrats on the quarter. Thank you.
Thank you.
Thank you. Next question is from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. So a couple of questions. So could you throw some light on the LAP portfolio? How has been the 4 years now, and how are we distinct vis-a-vis industry? Second is you sort of alluded to this, but still, just don't mind me harping on it. So 30 DPD has spiked to 4.7%. Even stage 2 has spiked, but we've not seen much of movement in our PCR or ECL provisioning. So if you can provide color there, and also any sort of customer cohort or ticket size or region-specific challenges. I remember last quarter you sort of pointed out Gujarat, Uttarakhand growing slower, and certain sort of challenges in particular markets. So if you can just throw some color there. And lastly, just a data keeping sort of a question, like what is the attrition rate? Yeah, thanks.
Yeah, many questions, and if I miss something, please point me out in between, Shweta.
Sure.
So, if you talk about lab per se, we try to focus again. The norms are not very different, where the FOIs in terms of 50-55% and LTVs are lower than 50%. That is for the lab portfolio. Our focus largely in this tier 2, tier 3 market that continue to remain for the self-employed segment. Most of them who are generating their own incomes in those markets by serving those vicinities and all, that continue to remain there particularly. So this is a focus area particularly. So if you talk about month on month, we are observing that in some months there is a spike which is coming, some months it's dull, and there can be various factors around that. Sometimes it's a monsoon, sometimes multiple things. But our thought is not to go break into month-on-month pieces. It is ultimately to continue to remain in that segment of 30-35% of growth. That we are committed and that we are focusing on directly per se. You talk about some terms of stage 2, right? For stage 2, can you take it up what he exactly said, what the number she was talking about?
So can you please comment?
Can you repeat, Shweta, once again?
So, both 30 DPD as well as stage 2 saw some material spike, right? And we've been seeing this trend formation like over a year now. So any customer cohort, any specific ticket size or any geographic challenge you want to attribute this to?
So I can give this, yes, there's a 20 bits hike than the previous quarter. Obviously, this is hike, which is there particularly. But as we see the traction coming in month of September back, as I mentioned, August was literally not as a great month, but as we think that, we feel that there is going to be sticky around this piece, little bit more, maybe 4.7 come to 4.5 or something that way. That's what we feel so in coming time. But let's see how the things turn around basically. So we don't see things going out of proportion or something that we have to worry about it. So there is some sense in market that we are also passing through, but we are confident we'll be able to pass on. So I don't think that we have to read very much large numbers out of this between the lines basically.
So lastly on the attrition rates.
Attrition remains constant in same range. What is we are observing in last year or 2 years. In fact, today board has been kind enough to approve the numbers what we discussed last time to include all the branch managers under the ESOP scheme. So almost 13.75 lakh of stock options will be given to the branch manager level, where we're going to include almost 500 new employees in the ESOP pool, which is a pretty large chunk to cover them under that scheme, which are normally the frontline staff, which includes branch managers, branch collection managers, and good performing branch head managers. So I think these are the some tools that we are using it, and we are hopeful they should going to support in one way or other way for the attrition side also.
Perfect, sir. Thank you so much, and congratulations on a good quarter.
Thank you. We'll take our next question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers, especially during current time. So my question is actually related to that thing. So we have more than 40% shares between 5 to 10 lakh rupees ticket size, and most of the players, especially in the lab segment or a few of them from the affordable housing segment as well, are highlighting stress, or they have changed their strategy to disperse on a stop below 7 lakh rupees ticket size loans, which essentially means that the stress in that segment is relatively higher. So what is the asset quality performance of this particular pool, and also how confident you are that over the next 2 to 3 quarters this segment should not sort of result in a higher credit cost and what we difference currently?
So Ramesh bhai, if we compare the same quarter compared to the last year, typically in this ticket size, what we're talking about 5 to 10 and around that piece, our numbers largely remain same, that piece. I can understand that few of the institutions which may not be part of housing finance company, they might be finding this problem, because this is the point of discussion which happened many times in past also, that if you don't have a SARFAESI right, then there is always a scope of struggling around that piece. So I think that challenge does come because those rights are not for the institution which are not a housing finance company or the bank. So they find this kind of challenge while doing that piece. So yes, if there is slight stress, that stress percolates to the more intensity if you don't have a tools to control that piece. So fortunately, as a housing finance company, there are some role which has been played by the surface that way to curtail that piece. So that remains almost same when we compare year on year. Same September numbers continue to remain the same number when it's about the negativity.
Got it. Okay. So, concluding this, I mean, we don't foresee any risk from this pool in coming quarters.
So we are continuing with this pool. We are not stopping it because we get a better yield than in the markets where we operate tier 3, tier 4, self-construction houses, someone who want to extend his home. There's quite a few cases where we get this opportunity around.
Got it. And just a last question on the return on equity front, right? So we are already touching 17%, have been sustaining that number from last 2 quarters. And now, given your growth guidance of 30-35%, with increasing leverage, where do you see ROE settling in near term?
I think there are many aspects to that piece, but I think what we focus, we just focus on our ROE alone. So the guidance remains safe on the typical 3-4 points, and you can easily calculate it. It's not difficult to make it up. So we want to continue where credit cost remains in the same segment of 40-50 bits. That's our thought, and again growing with the loan growth of 30-35%. So more than focus, our objective is more on the operation side. But what is running around, I think that is something which doesn't look out of scope. That is quite manageable. So we don't want to comment on ROE per se, but I think in a range properly where there's expectation around.
Got it. Okay. That is from my side, sir. Best of luck.
Thank you.
Thank you, Ramesh.
We'll take our next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. My question was pertaining to the BT out rate for the quarter. If you could give that detail.
Yes, Shripalji. I think when you see the market trends are a little tough, you always find there are some green shoots also, and I think BT out rate is one of that. What we're realizing, BT out rate is curtailed well, decent in the range bound, what we talk about. I think that is again 4.5% of BT out range, what we can see around basically. That is the thought, which is comparatively slightly better than what it was a year back or 2 years back.
Okay. Got it. And sir, on the cost of fund side, so how do you see that number ending for FY26? And what % of our bank borrowing is linked to repo and T-bill? So how do you see that benefit flowing in on the cost of fund side, and where do you see it ending for the full year?
So on the borrowing side, about 32% of the borrowing is linked to repo rate or T-bill, wherein largely the benefit has already flowed in. And remaining borrowing, about 15% of the borrowings are at fixed rate, and rest of the borrowings are linked to MCLR rate, wherein the benefit is coming in a very gradual form. But the good part here is that if we see our bucket cost of fund, that is at 8.5%. Incremental borrowings are running at about 8.1%. So the blend of the new borrowing and the old borrowing will keep changing. So we expect that by year end we should be having another 20 basis point reduction in our overall bucket cost of fund.
Okay. So further 20 basis point of benefit is what we expect for the full year. Got it. So that is it from my side. Thank you so much for answering my questions.
Thank you. We'll take our next question from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good evening. Can you hear me?
Yes, please go ahead.
Right. I have just wanted to check on the BT out. So, what is the percentage of AUM that goes out on a monthly basis? What's the total fee?
Yeah, Subhranshu. So, BT out as a percentage of average AUM is in the range of about 4.5 to 5% briefly. and that is, consistent in last 2 quarters. But if you compare it year-on-year level, it is down by about 100 basis points.
Okay. And do we have a dedicated team to arrest this attrition?
Yeah, so we have a centralized team, who is engaged in the customer retention. So whenever we, come to know that customer is looking out for loan, our team, proactively connect with the customer and try and retain the customer.
Okay. And what is the major reason of still the people who are going out? Is it just the drop in interest rate because they again have to pay fees any which ways for the loan, right?
Very difficult to, judge that at the moment when he's moving out, basically. But largely there are 2 reasons. One is going for the more loan amount, and yes, obviously, rate drop is also the option which is there. And when you are operating these markets, there are nationalized banks and all, which does operate at very, very, lucrative rates. That's an option given. So irrespective of paying fees again and all, that location is good enough to move out sometime.
Understood. And given the fact that you spoke about the nationalized banks, are these guys also chasing us in treasury to take up loans? Are they coming up with cheaper pricing for us? What is the translation of the cuts till now for us?
So for, if we talk about the PSU banks specifically, so PSU banks, if you see the borrowings are linked to MCLR, and there is not much movement in the MCLR of PSU banks at this point of time.
Right.
So, the benefit of rate cut from PSU bank is limited to about, 20 basis point till date. But we expect that as their, deposit ratio between the new and old will keep changing, the benefit will keep coming gradually over the year. And so as and when the reset of those borrowing will come, the benefit will keep coming on that borrowing.
Right. And have they become more, both PSU and private banks, have they become more aggressive towards that treasury?
So liquidity in the overall market is, quite good at this point of time. So everybody is looking for, quality lending. So we are seeing, good aggression from the bank side to fund at this point of time.
Understood. This was very helpful. Thank you so much.
Thank you. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead. Abhijit,
Hello.
your line is unmuted. Yes, please go ahead.
Yeah, hi. Good evening, everyone. Thank you for taking my question. Vipin, I joined about 15 minutes late. Apologies. So in case my questions are repetitive, please let me know. I'll look up the transcript. So just 2 things I wanted to understand. One is, a lot of participants in this call have already asked about asset quality, the fact that stage 2 is inching up. And we're seeing that across some of the other affordable housing finance players as well. Again, pardon me, but I don't think this is just a seasonality-led what we are seeing today. Because somewhere there is an acknowledgement that in addition to seasonality, which is about maybe rains in the second quarter, there is also some spillover that is being seen from MFI, micro lab into affordable. Somewhere we see an acknowledgement that, there are pockets like maybe Chennai, Surat, Tirupur, right, which are exhibiting some localized stress, again, primarily because of tariffs. So I understand, like in last year, right, but pulled back very, very strongly in the fourth quarter. But this year, is it looking like any different, or you think that this is just one edge deterioration and things will definitely get better once we move into the second half?
Thank you, Abhijit. I think we answered this question, but yes, we have not only said seasonality. We said when overall industry is impacted, so some heat gets purged into, entire ecosystem, and that does affect a little bit. But what we have to see what are the guardrails and how we are reacting to that piece. That's an important piece. Fortunately, the market where we operate, the ticket size in the tune where we can apply various norms, and there's a reason. Though there are certain slippage in certain buckets, but when you talk about overall number, whether it's a credit cost or this thing, we are able to maintain. So dynamics keep changing month on month, quarter on quarter. That's bound to happen when you're running a long run business. So does it going to affect it? It is only help you to prepare better. That's our thought. That's our philosophy working around that piece. You have seen since you appreciated the last quarter of previous year, and I think that was the obvious reason that preparation helps into that side. So I think that keeps building our capacity and appetite to face these kind of changes which is happening and which are very dynamic particularly. So I don't think that we have to overly concerned about it, but yes, operationally how to execute, that is more important, that we on the job. And maybe that's why this set of customers, if he moves to 90 plus, bringing them also become easier because of the tools which are available in form of SurfAC or in form of LTVs and all, and that's being used very effectively. And this you can see also, even if there is some inching of which happen in certain DPD, certain buckets, but if you see the GNP is very well in control, that happens particularly that way. So instead of going month-on-month basis or quarter-on-quarter basis, there may be little slip here and there, but our focus is more on execution and we are confident on that side.
Got it, sir. And then the last question I have is, earlier in the call I saw that, you continue to guide for that 30-35% year-over-year growth in AUM. I think which is a very good thing, and I think that at our current size, which is about 9,200 crores of AUM, we should do that. Having said that, sir, don't you think, given that, at the overall industry level, if there are some concerns emerging, maybe, and also because we have a good exposure to the self-employed customer segment as well, don't you think, it would be maybe little prudent to slow down a little bit, see how things evolve, and then kind of maybe grow strongly after things have settled down? I just wanted to hear your views on how we are approaching this, given that for one thing, that the self-employed customer segment, right, in case some of the things that we've seen in the last 6 months, they continue for some more time, will exhibit vulnerability going ahead.
So I think we are into this business for many years together. I think a company from day one, when incepted, the focus always remained to self-employed because they feel the market where we operate, the product what we are into that suits maximum in that term particularly. And while you are executing on that side, you also hone a skill for underwriting those set of customers and how to deal in terms of problems and challenges which has happened. So companies faces the time of COVID, the times what happens in the demon side and how the tools has been developed. So one side there is a mechanism which is on the underwriting side, other side then there's a mechanism of collection and of dealing side also basically. So what on basis of that only we project in terms of the going forward guidance and all, and that remains same. And that is the reason when we say that growth is going to remain around in tune of 30-35% and credit cost is going to be around between 40-50 bits. That we are focused on and they'll keep doing it. And as I mentioned, when you see the business, it should not be seen the business on a monthly basis or a couple of months basis. It is for a long range, and your guardrail should work keeping in mind that you get the right optics on that piece. So we are on the job. We are the job on the field in terms of operation as well as execution. Both sides while making sure that lending is prudent and other side ensuring that the collection is very well intact that way. That's going to remain there basically.
Got it. And so just one follow-up on that. I'm just trying to understand, in this repo rate cycle, right, repo rate cut cycle, we're not seeing any affordable housing finance companies cut their PLR rates as yet, right? Won't it be more prudent that in an environment like this, maybe cut PLR a little bit, right? Take better credit quality customers, because at the same time, right, while our BTs have not inched up, like you said, it is still in the range of 4.5 to 5%. BT outs at the industry level are going up. So maybe with slightly lower pricing, which would mean slightly lower profitability, cater to a better customer segment, given the environment that we are in today.
So I think this is a model of someone who creates well, executes the business. Our model is where we deal with a ticket size of 10 lakhs around basically, right? And again, with the markets where we operate particularly. What you're saying, that may be applicable to someone, some different ticket size, some different set of market, where the competition is very different way and format around that piece. And I think largely the girdle has been created, as I mentioned there, to cover those things basically. But yes, as new customer comes, we definitely pass on what need to be passed as per the system mechanism. There our business rule engine and RPP model does work around that side and give them that output particularly. So that passes will come accordingly with time.
Got it, sir. That's all from my side. Thank you for patiently answering all my questions, and I wish you and your team the very best.
Thank you, Vijay.
Thank you. We'll take our next question from the line of Saptarshi Chatterjee from Grow AMC. Please go ahead.
Yeah, thank you so much, sir, and thank you for the opportunity, and congratulations on good numbers in a difficult times. Sorry for harping again on the asset quality piece. Just to understand that fundamentally, whenever there is a problem in the environment, it happens sharply, and then it takes a couple of quarters to repair the damage. But generally, as you were mentioning and other players are also mentioning, that it should be better in couple of months. So what is giving that confidence, or any on-the-ground insights that is giving us confidence that it should be better in couple of months in that way?
So what happens generally when customer moves from one bucket to other buckets? So there is always, you have to wait for a couple of months to realize that he comes back basically. So if it is in bucket 2, bucket 3, so customer has two options. Either to pay back and, become a normalized, or other option, if he is not able to do that, then he move to the next bucket, which is an NPA bucket, basically. So as NPA bucket starts moving to the NPA bucket, then definitely the other triggers which comes into the function, whether acquisition of property, using the tools around that piece of surfacing and all. So there then customer reach to the level of taking a conclusion and right decision, basically. And those decision are to close the loan on various basis. Either will try to dispose his asset and settle it down, because he also know the end of the day he has to pay interest and principal to the institution back. So that decision movement becomes more effective in that side. And in case if it doesn't happen, then obviously then another 6 to 7 months, sometimes it's 8 to 9 months, that you are able to possess and sell the property in the market. So the decision making point, because everyone knows that it's my asset which he has to keep it intact. He knows that as far as possible, if can manage it, let me try to manage it out. So those decision points come at certain level. So many of customers, they do come back after, being into those buckets for couple of months. And if that doesn't happen, then your tool gets triggered basically. So these leads to some kind of output in that way. And on basis of the trends, past trends and what data says, people are able to give you idea that couple of quarter or couple of months, they should be able to track it back.
Got it, sir. Very helpful. And
this is, since you asked the question about why in industry what happened, so I thought to give you more as a broader sense around that. I hope this is
very helpful. Yeah, very helpful. And on the for us, any customer level color, is it happening on any customer profiles where income is impacted, or any vintage of loans where the delinquency is happening, or any regional level problems? Any color on those asset quality?
So slight here and there keeps coming basically, and it's not because of current times or specific times. This is a trend. So if we are maintaining the GNP of 1.2, 1.3, what we are showing it from last so many years, it is not that during that time everything was neat and clean and suddenly something has happened. So when you are operating in 300 branches, executing this kind of set of customers, every time you find some challenges and trouble around that piece. For those set of customers, then you have to have a very clear understanding what are the tools need to be applied at what the right time. That's the learning that we learned by underwriting 2 lakh customers in the last 10 years.
Okay. And last piece is in terms of competitive intensity versus 1 or 2 quarters back, is it higher or similar or lower? Any color on the competitive intensity part?
That remains almost same. I didn't find much of change. It has not increased or decreased, but almost remains same. There are a set of competitors which are always existing, coexist together, and there is always a push and pull effect to a certain level. And I spoke this thing last time also, more than a customer, the intensity is more about pushing the people from one company to other. That is a more a role which competition plays around. This is the trend which has been observed.
Okay, sir. Great. Thank you so much and all the best for future.
Thank you. Thank you so much, Saptarshi.
Thank you. We'll take our next question from the line of Vaibhav Lohia from CFM. Please go ahead.
Hi. Thanks for the opportunity. So I just wanted to understand what is the aspiration for the next 3 to 5 years? Like, before we have grown around 40% CAGR for the past 3 to 5 years. So, like, where do you see yourself in the next 3 to 5 years? And we have this question.
So next couple of years, what we feel, we want to grow in the range of 30-35%. That is our thought, and that's the way we are trying to build our model, businesses, and our structure accordingly. So this is something what we are looking for next couple of years.
Okay. That's helpful, sir. Thank you so much.
Thank you. We'll take our next question from the line of Siddharth Chandrasekhar from SJN Securities. Please go ahead.
Hi, sir. Am I audible?
Yes, please go ahead.
Okay. So my first question is about our lab business. So what is the maximum and the minimum interest rate that we charge to the customer, and what is the LGD of that portfolio, historical LGD?
Ticket size remains 10 lakhs, and rate what we are charging is anywhere 13 to 16.5, 17%. Again, depending upon risk-based model, basically, risk-based pricing, how it works on that piece.
So on the on the PD LGD side for this lab customer, so generally historically we have seen PD of this customer remain higher by about 20-30 basis points. But given the fact that they have a quite lower LTV, so our LTVs for lab loan is at about average about 45%. So we have seen that LGD remains lower than the home loan cases. So on a net basis, credit cost between home loan and lab is pretty much similar when we apply both the PD and LGD.
Okay. So, sir, when it comes to that, when once a portfolio move to an NPA, right? So, where is the maximum probability, it get recovered, right? Is it because you are selling the property or doing a settlement? How it usually happens?
So generally, so given the fact that we have access to the SARFAESI, we have seen historically that if the customer moving into an NPA bucket, so we invoke our SARFAESI process wherein customers generally comes out for a settlement. They call their friends, family, and offer for the settlement. And generally this trend remains for their about 85% of the total NP cases, and remaining 15 cases we have to go for auction and close the loan.
Sir, usually this happens, right? So we usually value some metrics to some value to one property, but when it comes to the auctioning of these things, right? We might not get the actual value, right?
You are right. Yeah, please continue.
Yeah, that's all. Sorry, yeah, you can go ahead.
So I was saying that generally if the customer is coming for settlement, then the losses remain lower in the range of 9 to 10%. But in the rare cases, wherein the settlement couldn't be concluded and we have to go for auction, and those are very rare cases because of some family dispute with the customer wherein he is not able to sell the property. Losses got slightly higher in the range of 22 to 25%. But at a blended level, since the cases of auction are very limited to the tune of about 12 to 15%, the overall LGD remain in the range of 11 to 12%.
Okay. That's helpful. So the second question is about our off-book strategy. So what is the spread that we earn from our off-book, whenever we do the co-lending or assignment?
So in off-balance sheet strategy, we generally do our lab loans only, both in DA and the co-lending. So our average yield on the lab portfolio is close to 15.5%, while average cost of fund is about 8.5% for the lab book. So broadly, it is about 7% margin that we get on this off-balance sheet portfolio.
And on-balance sheet also we do the same?
On-balance sheet is also same, but it includes both the home loans and lab. So obviously, also on the home loan book, the margins are lower, and the lab, the margins are similar at 7%.
Okay. Sir, is there any thought process that you have given, basically like our capital adequacy, right? So it's right now it's beyond 50%, right? So is there any thought process put behind, right, for the time being, slowing down the off-book strategy and using a better capital, then we expand this, right? Any process on this?
So, off-balance sheet strategy is not a function of CRAR exactly. So it's a function of, various funding sources that the company need to bank upon. So as a matter of, diversifying our funding sources, we have devised a strategy that, that we will keep a part of book in the form of off-balance sheet, and that strategy says that briefly in form of DA we will raise about 16 to 18% of our total funding. Co-lending, we will go up to 10% of the total book at this point of time. Our thought process is. So these off-balance sheet sources give you a very long-term funding, which you generally don't get in the form of term loan. So that's how it is always good to keep a blend of both on book and off book.
Okay. So just a last question. So any update on the rating upgrades or any discussion went on?
So, our last rating upgrade has happened somewhere in July 2024, and we have not even concluded about 2 years from the last rating upgrade. So we expect that, once we, conclude the vintage of briefly about 18 to 24 months from the last rating upgrade, we will be in position to pitch the rating agency for like another rating upgrade. We will wait for a quarter or so before, pitching to the rating agency for that.
Okay. Yeah, thanks for answering this question.
Thank you. We'll take our next question from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Great set of results. Just wanted to quickly understand, I joined 10 minutes a bit late on the call, so I don't know if you've already answered this, but at the cost of preparation, I'll just go ahead and ask. So when I look at your 30 plus stage 2 and your GNPA, 30 plus and stage 2 have increased, but GNPA has not increased that much. So what is it that we are doing that we are arresting the slippage and not letting it fall in the higher bucket?
So, in stage 2, as we have said that, the customer remains generally sticky. If the customer has missed 1 or 2 EMI, they generally they are not in position to pay, couple of EMIs together and come out of the stage 2. So, and while moving to the stage 3, everybody, has that concern that, if they move to the stage 3, then then the company will invoke the SARFAESI process. And the company is also very strong in terms of, recovering money out of the overall NPAs. So that's why, you are seeing some accumulation happening in stage 2 for the time being. But the moment, the overall scenario will improve, either these cases will go to the standard assets, or in case they move to the NPA stage, we will be quickly invoking our legal recovery process and do the resolution of the same.
Understood. So just one last point. Have we taken any write-offs in first half of 26?
So we have, very stated write-off policy since last 4-5 years that any account which move into NPA bucket for more than 2 years, then we do a write-off. So in this last quarter Q2, we have written off about 5 crore of such NPAs, but parallelly we have recovered about 3 crore of NPAs that we have written off earlier. So that's a regular churning that keep happening between NPA bucket and recovery out of these write-off accounts.
Understood. And so last year in FY25 Q2, we had said that we had some leadership transition in our Madhya Pradesh state, that the state head and branch head had moved out, and we were facing some difficulty, and because of which asset quality had spiked up at that point. Do we see that the issue with that state has been resolved, and we can expect now moving forward a resumed growth rate, what we are seeing now?
Yeah, around 7-8 months we are able to hire a new leader, and I think he's picking up. Yes, we have given gestation period to that gentleman, and it looks the things are on track, and we are optimistic about the future, the way MP looks going forward in terms of output that we look forward. So the team is stable now largely. The question what we want to talk about.
Perfect. Thank you so much, and Rupinder and Ashish, wishing you all the very best.
Thank you. We'll take our next question from the line of Meghna Luthra from InCred Equities. Please go ahead.
Yeah, hi. Thank you for giving me an opportunity, sir. Sorry, even I joined a little late. I'm just taking the forward.
I'm sorry, your voice is sounding muffled, Meghna. Meghna?
Can you hear me better?
Yes, please go ahead.
Hello?
Yes, we can hear you.
Yeah,
Please go
hi.
ahead.
Thank you for the opportunity. Sorry, I joined a little late. I'm just taking the previous question ahead. Can you give some color on the process of recovery that starts once an asset is in stage 2? And my second question is, with an AUM growth of around 30%, so do you expect the LAP proportion to change, or would it be at a similar level?
I think we have an intent to continue with the 60-40 ratio, though there's a slight gap between 60-40. We are 57-58 and 40 to 41% on the other side. So we have an intent to continue with the 60-40 ratio, where 60 is the housing and 40 is the LAP. That is intent going forward also. This is the way the model has been created at markets where we operate around particularly. So once customer move to NPA, it's basically surface invocation which happens from 13 to then some time you have to give in terms of 60 days or something, then 13-4, and then we go for a DM orders and acquisition of property. But it has been observed more than 80%, 85% of customers, once you invoke the surface rights, they try to faster their process of settling the loan amount. That has been seen there. So the entire process, which takes normally 8-9 months, only 20% of customers reach to that level, where you have to reach to that extent, and then some part of that you have to possess and sell it out of that.
Okay, that's very helpful. Thank you, sir. That's all from my side.
Thank you. We'll take our next question from the line of Sonal from AMSEC. Please go ahead.
Thanks for the follow-up opportunity. So just, sir, if you could just highlight a bit on credit filters that you've applied, during Q2. Also, if you could just give out some data on how the delinquency trend is moving in home loans and LAP. Any segment that you see where the delinquencies are higher, within the two. Similarly, on the self-employed and the salaried customer segment. And when do we do ECL reset every year?
Between HL and LAP, I think there is, if we are at 1.2, LAP will be around 1.3 and HL be 1.1 in terms of these numbers. So there's around 18-20 bits of gap which does remain between HL and LAP when you talk about the numbers around that piece particularly. As for the tweaks that we keep doing it, that's a continuous process which happens in our BRE, business rule engine, while curtailing this customer. So irrespective of timings and all, wherever we find that some branches we need to tweak in terms of BRE, we try to make it up. There's a mechanism internally where we use our data science team to give an output, and basis that BREs are updated. And on basis of that, those tweaks happen in terms of in those markets, how the things has to be tweaked, whether in terms of FOIR, whether in terms of certain segments or geographies, all those things that we have to keep in mind. That's an underwriting tool altogether that works in that particularly. Third thing you talked about, what was
ECL reset. ECL reset frequency.
So our ECL reset frequency is, briefly, it's a model which we are running since last 5 years, and this model is behaving well. So whenever, like COVID situation have happened, we have done some tweaking, built in some, assumption to compute higher ECL. But since, last 3 years, we are seeing the model is behaving well, and there is no change in assumption which is required briefly, and we compute ECL every quarter, recompute every quarter.
Okay. So just another question was, what is your fixed rate book currently on the asset side? And how do you see spreads evolving? Because, we spoke about, probably Q4 exit, cost of borrowing will go down to 8.2%. So our spreads would ideally, logically, they should go to about 6.6, 6.7%. So, some commentary around that, and, how do you see yields moving from here?
So, about 15% of our book, loan book is at a variable rate,
And then we have about 35% of the book, which is at a semi-variable rate, wherein the reset will start doing in from FY27. Then remaining 50% of the book is at a complete fixed rate. On the liability side, as we have said that there will be some reduction in the cost of fund, which will flow to us in the tune of about 20 basis points. So we expect that by year end we should be reaching overall cost of fund at about 8.3%. That is how. So there will be some temporary expansion in the margin. You are right, to that extent.
Okay. Thank you. Thank you, sir.
Thank you. We'll take our next question from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Yeah, good evening and thanks for the opportunity. So I went a little late, so I don't know if it is answered or not. So I have three questions predominantly on growth and demand. So the first question is, some peers have kind of called out macro softness impacting disbursements. So and we have posted decent growth, right? So any qualitative differentiation you can talk about in terms of our customer base or any geographies or something on that? Second question is with respect to, have you observed any moderation in lead conversions, sanction to disbursement ratios or approval turnaround times in recent months? And third, is the demand strength you are witnessing more in urban centric or broad based across semi-urban and rural areas?
So we are spread largely into tier 3, tier 4 market. Our most strategy is not in urban market, but those markets which are semi-urban. That's the focus area. Areas around that piece. And that again catering the segment which is more on self-employed who are dealing into those vicinity. They may be a small cloth shop, cloth merchant, street mart, small mechanical shop, whatever it is basically. And these are the businesses which generate income on weekly, monthly, even daily basis basically. So that is the way their income generates on that piece, and their ecosystem is very stagnated to those vicinity where they are operating it. They are not something which is going to get impacted by situation like trade wars or exporters of that piece basically, since they are all self-employed in that category. And most of them, they are something who are not been a part of a strong banking ecosystem particularly, and a segment of customers who want to have their own house or take a small loan to fulfill their needs and requirement of that working capital. Those things are the set of customers we try to operate that piece. So we find this is a huge, humongous market, and as we go deeper, there's a scope of improving that piece. There are some challenges that does come on the basis of sometimes seasonality or something which is not picking up, and that keeps moving month on month or sometimes quarter on quarter, zone by zone basically, because we are spread across 15 states in a country. So those things you do face when you're into the operational activity per se. But when we see overall output, I think we don't find much of challenge on that piece. Yes, when there is a heat around, you always have there is scope of something missing out here and there, because market is not booming particularly, but we are not affected because of what is happening around basically. There is small impact on that, so it keeps happening particularly. So these are the trends which you keep finding, not only during this time, but any good and bad time across basically, when you have expanded operations across in so many geographies.
Fair enough. Sir, anything on that? Anything we have seen moderation in terms of lead conversion or sanction to disbursement ratio or any turnaround time?
Our logins remain almost, as per the plan. Yes, you keep tweaking the tools of your underwriting at that time. You'll always find that you try to churn around those things. But sanction to disbursement is also equally good that way. So little upshoots and that keep coming around that piece, but nothing which we have to be concerned about or we would change the strategy on that side.
Okay, and sir, in terms of demand strength, it is broad based, right? That is a fair assumption across states in which you operate.
Yeah.
Okay, thanks a lot, sir, and best of luck, sir.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to management for closing comments. Over to you.
Thank you everyone for taking your valuable time for attending our earning call. Also an audio recording and the transcript of this call will be uploaded on our website in due course. Looking forward to hosting you all in the next quarter. Further, if you have any questions or require additional information, please feel free to reach us out. Thank you so much and good night. Thank you.
Thank you, members of the management. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.